What's up, guys? Welcome back. Today, some more tools and tricks to put in your toolbox when you are trading options. Something that's been coming up a ton recently, especially with what's going on in the market. I mean, the market is pretty much defined by volatility right now. So today I want to talk about what implied volatility is and what it means to you as an options trader, and also this thing that you might have heard of called Ivy Crush, and how we don't want to be buying options around Ivy Crush times like that, when you could look out for it. When is it good for buyers? When is it good for sellers? I'm going to show you a couple examples, and then by the end of the video you'll understand what implied volatility means, or this exposure to Vega. So first, let's break down what is implied volatility. Well, what the heck does that mean? Well, we kind of know volatility is what's the likelihood of this thing going to go up or down. So the implied volatility percentage, it's essentially going to tell us how much percentage that stock is expected to move in 1 year's time, either up or down. So I have something with an implied volatility of, say, 20. That means it's expected that in a year, that particular share price can go up by 20% or down by 20%, most likely. Now, as we know, this is changing every day, and this is not an exact science, but that's kind of the rule of thumb that we can think about. But knowing that doesn't exactly help us figure out how we can use this to our advantage and how we can avoid this Vega exposure. So I think the easiest way to show this is to actually use an options chain. This one's from Webull. Guys, if you're new to Webull, they have a great platform. You could trade options and you could sort by the things you see, which is why I'm using it. I'll leave a link down in the description below. If you put in $100, you get 2 free stocks on Webull. A great platform to try. I like to use them all, but this is what I'm going to be using for this example here in showing implied volatility. So what we're looking at for people that are new to Webull, on this side, we're going to have the calls, and on this side, we're going to have the puts, and this is pretty much going to be the strike price right down the middle. I don't have the bid and ask here. I'll just put the last price, and that's all that we really need. As we can see, as we go deeper into the money on this side, the premiums are going to increase. These are things that we know already. And right here is the implied volatility, and like I said, this is the likelihood that this is going to change by this amount of percentage. And I get asked all the time, like, what's a high or low, or when is the implied volatility high or low? I'm going to get to that in a second, because it really depends more on the history than the actual number today. Now, how does this implied volatility affect the premium price? Well, we know that if we have a premium, that premium is broken down into 2 legs, essentially. It's going to be the intrinsic value, and it's going to be the extrinsic value. Now, just to review, the intrinsic value is for in-the-money options. It's how much profit you can get if you exercise that option right now. But this extrinsic value is really time decay, or time value, and implied volatility. And the 2 of those kind of working together. So the implied volatility, this affects the extrinsic value of the option. And this is kind of when you're going to see sometimes you can pick the right direction of the share price. The share price is going up and you're like, why is my option price going down if my share price is going up? Well, what's essentially happening is implied volatility and theta are hurting you more than the intrinsic gain from the share price going up. So that's why it's important to understand the volatility at certain points during that option contract. So now in a minute, I'm going to show you 3 ways to really avoid being affected, or this Vega exposure being affected by implied volatility. But let's talk about how this works over time. So share price and implied volatility are generally going to be indirectly correlated. So as the share price is going to go up, implied volatility is going to go down. As share price goes down, implied volatility goes up. So that's one thing we want to kind of recognize. Let me show you what that means. So if I'm looking at a chart of the share price, if this share price is going down, 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 what we expect to see from implied volatility is that implied volatility going up, 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 up. Now what happens if after that dip it starts to rebound, what happens is the implied volatility, it rebounds in the opposite direction, hurting you if you have options. So let's say, for example, right here, you bought a call right at the bottom. Well, right at the bottom, now the share price is going to go up. So you're like, oh, intrinsic value is going to go up. But what happens is now the implied volatility dives, hurting your extrinsic value. So your share price is going up, but your value of your options going down, and things get really, really confusing. So we have to look at what's happening with the implied volatility over time when we're about to buy calls. So that's one thing that you definitely have to think about. Right after a dip, right at the bottom of a dip, you don't really want to be buying calls. It's so tempting, but really you have to look at the implied volatility when you're doing so. You kind of want to be somewhere in the mean here, where we're going to have some sort of mean implied volatility, and I'll show you what that mean means and why it's important in just 1 second. So here's a general rule of thumb we're going to think about. When the implied volatility is high, we want to be selling contracts. And the reason for this is we want the value of the option to go down, because we want to buy to close them at a lower price later. If IV is low, we want to be buying contracts and we want to have some sort of debit spread. And the reason for this is as implied volatility goes up, so is the value of that option. We can sell to close at a higher price at which we paid for it. So what did I mean before when I said that these specific numbers don't really mean anything? Well, this could be a really, really high implied volatility for Apple, but it may be a really, really low implied volatility for another stock like GameStop. And here's why that's important. So we have to look back at the past. Now there's sites you can do this in, and you can find this free information. You can use other websites with paid. You kind of got to see what platform you're working on and find this chart. But what we want to look for is the implied volatility over time. So if this axis is time, I don't really care what this percentage is, because implied volatility is going to do things like this. And inside that implied volatility, what's really important to us is the mean or the average. So the average of this implied volatility might want to be, say, here. This average is what's important to us because we know in statistics, things are always going to revert back towards the mean. Meaning when I'm right here, there's a greater likelihood for me to come back down to the average than diverge away from it. So this is a spot that's high. Now this value over here, it could be 33%, it could be 34%, it could be 50%, could be 100. It does not matter. What does matter is in relation to where it was a little while ago, it's now high. So this would be a spot that we want to be looking to start selling some contracts or making some credit spreads. When I'm down here, there's a greater likelihood for this implied volatility to increase back to the mean as opposed to diverging away for it. So this is a position where we want to be buying options and buying some sort of debit spreads because we know as implied volatility goes up, extrinsic value is going to go up, the value of our option is going to go up. That's going to be a great thing. So we use this past history and we also use Vega, right? Because Vega is going to tell us how the value of that option is going to change with 1% change in implied volatility. And we notice right here at the money that the Vega, all right, this Vega exposure is going to be the greatest. The further away from the money I get, the less Vega exposure we have. So the less exposure to this implied volatility affecting our options. And that's going to be very, very important when I tell you 3 ways to avoid this. But I really want to use this graph right here, and I want to talk about what happens in IV crush. So essentially, IV crush happens after a period of unknown inside the stock, all right, where implied volatility is really, really going to be high. And this is most seen right before earnings, because before earnings come out, we have no idea what that company is going to say. So many things can happen and volatility is going to be the highest. So let's say we have an earnings date that's like right here. Here's going to be the earnings call. Well, leading up to earnings, what we're generally going to see is that unknown and implied volatility is going to rise and rise and rise with the anticipation that there is going to be some news coming out in this earning call. Now what happens when we get to the earnings call, there's no more unknown, right? That volatility goes away due to the unknown. And what happens is this implied volatility, it starts to compress and it dives down quickly. So what happens, the closer we get, essentially we have an inflated or, a non-standard premium price that can screw us over. And here's what I mean. Let's say you bought a call right here. And then from here, the share price kept going up and up and up. So this is going to be the share price over time. Now the share price starts to go up. It's a great earnings call. Everybody's happy. The share price goes up. So you're like, okay, well, the value of my call should go up. Well, what happened was you bought it here where this extrinsic value from the implied volatility was the highest. And then at earnings, it just dove down and it just crushes, literally crushes your premium value. Let's say maybe you bought it here at 900. It got up to here, maybe it got to like $1,000 right here, and the share price went up in rising its intrinsic value, but then theta kept going and evaporating extrinsic value, and now implied volatility gets crushed, eating away and evaporating extrinsic value, and now you find yourself a couple days later where now you're at $600 and you're looking to sell to close, and you're not going to sell for $600 when you bought for $900. Now we have to wait a long term or a long time for either this implied volatility to change or for this share price to go up so high that the intrinsic value offsets this loss of extrinsic value. So that's why when people say like don't buy options as earnings approach, this is the reason why. Because the implied volatility is raising up the price of that option to a level that's going to go back down to normal-ish right after earnings and right after that implied volatility goes away. So there's three ways that I really think of avoiding this Vega exposure and being affected by implied volatility. There might be more. Please feel free, leave them down in the description below. Avoid buying options in moments of high volatility, right? Earnings call or things like that. And remember, high volatility is relative to the previous trend of that volatility line. So just avoid that. Start with just avoiding when earnings calls are, guys. And these are things you need to know when you're trading options, right? If you're going to be trading options on companies, you should know when their earnings are coming. You should know when dividend dates are coming, things like that. This is part of your due diligence. So understand, I want to buy a call on Apple today. Let me check and see where earnings are, and let me look back and see what the implied volatilities look like over the last couple of weeks to make sure that this is a good idea for me. The next way to avoid this would be to buy calls that are in the money. And you might be saying to yourself, Brad, if I go out of the money here, my Vega is 0.01. And if I go down here, my Vega is 0.01. Now, when we're buying long calls, here's why we don't want to go out of the money. As this share price right here goes up, which is what we want to do when we're buying long calls, right? As the share price goes up, well, what happens to the money? The money is going to move closer to this particular strike price. And as we see, as the strike price gets closer to the share price, Vega is going to increase. So we want that share price to go up. So if you're buying an out of the money option, besides the fact that it's hard to get to break even, it's a lot cheaper, things like that, if you're going to be wanting this share price to go up, you are going to be increasing your Vega over time, which is not a good thing. Right now, it might look great, but as its share price goes up, so is Vega. And the other thing about the out of the money options is because they're so much cheaper, like look at this, $500 as opposed to $200, people are buying multiple contracts. And remember, when you buy multiple contracts, you multiply your Vega exposure as well. So if you were to buy 10 contracts at this price, your Vega is really going to be 0.1. Okay, so we have to think about that as well. When you're buying multiple contracts, think about how the Greeks are going to get multiplied into that as well. And the last way to avoid Vega exposure is to trade spreads. Now, this won't be a spreads tutorial, guys. I made a video about that. I'll link it at the end. But the spread allows you to dial in a few things and allows you to kind of set things to avoid certain dangers. And here's really what I mean. I'll use an example here. So I'm going to use these two strike prices just for math purposes and to show you what I mean here and how we could do this and trade spreads to lower our exposure. So we have a $119 and $120 strike price. So we have a $119 strike and we have a $120 strike. And this would be the buy, and we'll call this the sell. And we're going to look at Vega, Theta, and Delta. So I've written out the Vega, the Theta, and the Delta right here for this 119. Also, I'm going to do the same for the 120. So for the 120, we have 0.04, minus 0.24, and 0.7. So now we have Vega, Theta, and Delta. Now, guys, we know when we are buying and selling, right? Whatever happens to the opposite of the other person, right? So if one person makes $1, the other person loses $1, okay? So when we think about this, essentially, this is going to be the opposite. So this is going to be a minus, and this is going to be a plus, and this is going to be a minus. So by doing this, we see that the net Vega exposure is really just 0.01. So by creating this spread, we pretty much limited the amount that implied volatility can affect the premium of this option. But that comes with a little bit of give and take, because we see with Delta 0.79, we give up some of our leverage according to Delta, and we say now we have a 0.07. All right, so we have to, like I said, there's gives and takes and there's things like that. So if you really want to avoid this, right, a spread is a great way to do so, but know that Delta is going to hurt you by doing this. And you can dial this into your liking depending on how far apart your strikes are, things like that. But I think at the end of the day, really, this is the big one for most beginners. Okay, and it's the one that I see most beginners get burnt on. If you're not trading spreads, it does not matter. And we know that I love buying in the money options. I don't buy out of the money options really ever. Like I said, for most beginners, if you are learning about this and if this is your first time hearing about Ivy Crush, look at number one. Look at what your earnings are when you're buying options. And if you're selling options, we want to look for a high moment of volatility, because we want an Ivy Crush when we're a seller. We hate Ivy Crush when we're buyers. Guys, I hope this video helped. If it did, can you do me a favor? Just give it a thumbs up, leave a comment so the YouTube algorithm knows that you got some value and this was engaging for you. Until I see you guys in the next one, stay positive, work really, really hard. Always please be kind to other people. Hope you have yourself an amazing day and an even better tomorrow.